Capital Record, where we defend free enterprise and capital markets because we believe in the dignity of the human person. Hello and welcome to David Bahnsen's Capital Record, brought to you by National Review. For those of you watching on video, you can see I'm not in our normal spot in the New York office or our California studio. I'm actually speaking at a big event in Orlando, Florida for Kingdom Advisors, a big network of over a couple thousand financial people in the wealth advisory, financial advisory profession that are bound by faith. And so I am doing this remotely, but nevertheless excited to talk to you about a topic that is probably on nobody's mind whatsoever. But why would you bring up a topic that's on nobody's mind whatsoever? When I look at the things we've done so far, since Capital Record went to a more solo project of shorter but more frequent episodes earlier in the year, I think the topics we've covered so far have been on a lot of people's minds, around big pharma, around Fannie and Freddie, around even this CFPB, the Consumer Financial Protection Bureau. The other day doing one on the whole work from home, work from office thing. These are topics that are on a lot of people's mind, but I want to talk to you right now about the interest rates that are paid by banks, by depository institutions, and the new sort of scrutiny that is on. There's particularly a kind of investigation at Capital One that I'm going to have a little bit more nuanced view that might surprise people that do assume I generally take a laissez-faire approach to these things and most things, because I generally do. And I'm more or less going to be doing the same thing with this topic, but there's a nuance that's consistent with first principles that I want to play out. Okay, first of all, what is the topic? What are we talking about when we say deposit rates? Why does this matter whatsoever? Essentially, for those who don't understand the way banking works, you may be surprised to know that banking is a business that's profit exists in tension between how much banks pay in deposits to people who hold their money at the bank and how much they receive in loans. So they receive funding via deposits from depositors, and then they're allowed to, within all sorts of regulatory ratios and capital requirements, they're allowed to lend out some multiple of the deposits they've received. They are paying a certain amount to depositors, to savings accounts, to CDs, and that's an expense. And they are receiving interest income, and when they're lending out to businesses or mortgages for homeowners, car loans, credit card loans. And the delta between what they pay out in interest and what they receive in interest, between the assets of other people, which are liabilities for a bank, deposits, and the liabilities for other people, their loans and mortgages, which are assets to the bank. All right, so just basic accounting here. One person's asset is another person's liability when it's a loan, and vice versa. Deposits are thought of as an asset, but they're a liability to bank. That's money that's on demand, has to be paid back. It's money owed, it's a liability. The delta between the interest on these assets and liabilities is what is called net interest margin. And that net interest income, is expressed as percentage net interest margin, is the profit model of banks. So on one hand, you pay out a lot in deposit rates, you're cutting into your net interest margin, but you might be attracting a lot of deposits that then enable you to lend more money out and collect more interest income from the loans you're extending. And this is what I mean by attention for a business, for the business model of a bank, is you don't want to pay out more than you should, but you do want to receive more. And so there's a tension between the generosity, which is never generous. It's a business decision, an economic calculation, and what is paid out to attract deposits. And then, of course, you don't want to charge too little in interest income. But of course, this tension is different for some banks from others because really big, strong banks with a big brand, already established customer relationships, they may not have to pay a lot in deposit interest to attract depositors. And they may be able to be, not hyper competitive in what they're charging for loans because a lot of people are just used to borrowing from their banks. So they have kind of a competitive advantage where smaller banks have to pay more in deposits and charge less in loans and therefore have a lower net interest margin in order to attract business. And then of course there's other factors that go into who people bank with besides what they're being paid in interest or what they're being charged in interest to borrow money. Is there's sort of just the community relationship. This is why you see banks a lot, sponsor the local little league team, and they sponsor charitable tournaments. They build a little bit of a brand and try to establish relationships. Now, relationship banking has gone significantly downhill. It's one of the awful results of the financial crisis that there are less people there's less bankers who know their customers. There's less customers that care to know their bankers. And so you do have a lot of people that bank at some of the big firms, whether it's JP Morgan, Bank of America, Wells Fargo, just because of the size and brand of the firm that they feel it's safe and credible. But then that gives that firm a lot of leverage to not have to pay big interest for depositors. Generally, there's always a little more competitive pressure on loans because people can borrow money anywhere. And so usually if one bank is charging 6% and another bank's charging 7% to do a mortgage, it's tough to get that business at a 7% deal if you could go to the bank down the street and get a loan. But that money is always funded by depositors. And so that's the banking model in America in a very back of napkin, dumbed down way. But it's not a surprise that banks have a profit motive to not have to pay out a lot in deposits, a lot of interest. And some banks just simply competitively don't have to. JP Morgan's a great example. There are very few people that say, I've been banking at JP Morgan Chase a long time, and the things I like about them are in place, but you know what? They're paying me such and such a small amount on my checking account deposits, but another bank's paying more. I'm going to move the banking there. JP Morgan just really doesn't have that kind of pressure. But then, local community banks, often they may not have the pressure either because they have built a brand. They have a community relationship sponsoring the local little league team and stuff like that. And so they don't necessarily have to be super price conscious either. But there's a lot of banks that do. And the economic model of paying less in deposits is what it is. So now regulators are all over Capital One because they're saying they lured people in on a certain deposit rate, but then they have some accounts that pay a higher deposit rate, other accounts that don't. And they feel that Capital One owes it to their customers to make sure they're getting the highest deposit rate possible. And there's been a lot of fines in this rate environment where interest rates went higher over the last couple of years, where people are saying you had a money market at Charles Schwab and you did not move your customers to the highest possible yield. So first, let's just do the first principles thing here on the free part, meaning free markets, free society, free enterprise. No one should be allowed to commit fraud. No one should be allowed to bait and switch, to lie, to promise one thing and deliver another. But it is a textbook fact that banks have the incentive to pay the least amount in deposit interest, and customers have the incentive to receive the most amount. Those two things are simultaneously true and hardly represent, in my opinion, an ethical quandary. Um, I would add, from the vantage point of the regulators, do you think the FDIC or the Treasury Department for that matter, or the Federal Reserve for that matter, all three of these institutions whose primary focus is stability of the financial system, do you think that they're worried that banks should be paying more deposit interest than they have to? Are banks not more capitalized when they're paying less in interest? Therefore, stronger, better capital ratios, better tier one capital, better protection of their own balance sheet, better cushions to withstand various financial distress. So it is somewhat paradoxical that the people who would go after these things are people that have every incentive to not want banks to be paying overly generous amount of deposit rates. So you go, Dave, what's the nuance here? It sounds like you're taking a pretty market-based approach to this. I'm taking a very market-based approach. Banks should pay exactly the amount of deposit interest that they choose to pay within the tension that exists in their very business model. They can attract more customers by paying higher amount, but they have a lower net interest margin. And somewhere in that fulcrum, as they turn the knobs up and down, is the business decisions that have to be made for a bank. Likewise, customers who, in the case of deposits, are lending to the bank, putting their money on time deposit with the bank, and when it comes to borrowing money, are themselves the borrower. So they are the one who is looking for a competitive rate of interest to borrow money for their business, their car, their mortgage, whatever. That's an embedded tension between a buyer and a seller, between a lender and a borrower. And I am all for the banks and the customers setting those prices. And I don't believe regulators have any skin in the game other than those that regulate the financial health and stability. The nuance is if there is bait and switch. And this is where, as much as I insist on advocating for a free society and a market economy and price discovery, I insist upon us promoting a virtuous society, and there is nothing virtuous about lying to someone to say, we're going to be paying you 4%, but then all of a sudden they're only getting 2%. Now, if in the fine print it says you're getting 4% for 90 days and then it's a teaser rate and it changes to 2%, that may be a different story, and people could debate what they think about the ethics of fine print. But my point is that banking institutions do themselves a world of favor by establishing trust, and borrowers do themselves a world of favor by generating trust. If what we believe is going to promote the free society and a virtuous society is greater trustworthiness, banks become more trustworthy by not playing games around advertised and posted deposit rates. And by the way, borrowers help themselves create trust and relationship banking by not shopping for an eighth of a point lower rate last second. Now, they're under no obligation to do it. They're under no obligation to borrow money from a bank if they can get a better deal somewhere else. My point is fostering a spirit of trustworthiness, of integrity, of cooperation. It cuts both ways. Banks undermine the trust, borrowers undermine the trust, and moving your money institution to institution every few months, trying to swap rates. It's legally allowed. But what that does is also then say to banks, well, then we're legally allowed to start you at 4% and move you to 2%, and then dare you to go through the inconvenience to switch in your account, which some will do, some will not. My point is that the fact that both people have a right to do this is not promoting the virtuous society if you believe the virtuous society is best promoted with maximal levels of trustworthiness. I think you build more trust by calling a spade and saying, look, this is our deposit rate. And when the Fed's lowering rates, we may have to lower it more. When the Fed's raising rates, we may raise it more. But the point being, I don't have any problem at all with JP Morgan paying 0.01% deposit rates, because that is a business decision that it's not part of their value proposition. We pay maximum income on checking accounts. But if Capital One says we have a high yield savings account, we pay 4%, but then really you find out that they moved you to a different account and you didn't know it, and you have to flick a button by scrolling through the website and you can't find it to actually get the higher rate you thought you were getting, I think it destroys trust. And just because I have a very strong premise towards a very strong bias towards the free society does not mean that I want to do anything that undermines virtuous society, which is promoted by maximum degrees of trust, which only come about by maximum degrees of trustworthiness. So that's the nuance here. Banks have a tension in their business model that is part of a market transaction that I'm not remotely uncomfortable with. And customers of banks have a tension that they could go away from fostering a relationship with their bank because they can go save an eighth of a point of interest here in borrowing, or get an eighth of a point more in interest there. And then they take on the cost of moving accounts and the inconvenience of that, not to mention the time. You couldn't pay me all the money in the world to have the time to go swapping around my deposit accounts all the time. But the point is, banks can create stickiness with value, and the value can come from low borrowing costs. The value can come from high deposit interest income. The value can come from relationships and sponsorships and brand and reputation in the community. It can come from online services where all your bill pay gets set up and then you don't want to go through the hassle of moving. There's all kinds of things the bank can do to earn your business. But one thing the banks can do to earn your business, and one thing the customer can do to earn the bank's loyalty to them, lend to them in the future when other people may not want to lend to them, when the underwriting gets a little trickier, but you need a relationship loan instead of something that checks all the boxes in underwriting, is for the customer to act in a trustworthy manner. This reciprocity of character, trust, integrity, it builds virtue and is fundamental to the free and virtuous society. Thank you for listening. David Bahnsen's Capital Record, brought to you by National Review. Send this far and wide.